All right, let's dive into Block's latest numbers. If you're an investor, you know these reports can be, well, a total minefield, especially with the headline figures. So we're going to cut right through all of that noise. We're going to focus on the one core trend that honestly tells you everything you need to know about where this company is headed. And where does all that noise come from? You guessed it, Bitcoin. That Bitcoin revenue, it just throws the top line numbers all over the place, and it does a really good job of hiding what's actually going on with the business underneath. But here's the thing, if you know exactly where to look, there's this incredibly powerful signal that's just slicing right through all that chaos. And it's not new. This is a trend that's been building up for a while now, and it's something you've absolutely got to pay attention to. So what is it? Here's the big takeaway, the whole point of this deep dive. A genuine profit machine is starting to fire on all cylinders. You can see it in the numbers. Block is on this clear, accelerating path to real, significant profitability. That's the bull case, right there. That's the story. Okay, but it's not all smooth sailing, not by a long shot. There are two pretty big risks kind of hiding in plain sight in the footnotes that could throw a major wrench in this whole story. So that's what we're going to do. We're breaking down the good, the bad, the bull, and the bear case. Let's get into it. All right, first up, let's look at the big picture. Forget the headlines you might have seen. The real story here is in the profitability numbers, and believe me, they tell a pretty compelling story about growth and, more importantly, about leverage. So, with Block, the number you always have to watch is gross profit. And look at that, it's strong. We're talking 18.3% growth year over year. And let's be clear, this isn't some tiny little beat. This is serious double-digit growth. It tells you the core business is healthy, and it's scaling up really, really well. Now, that percentage is great, but look at what it means in actual dollars. We're talking about a leap from $2.25 billion to over $2.6 billion in just 1 year. That's, over $400 million in new high-margin profit? That's huge. So the big question is, where's all that cash coming from? Okay, that brings us to the Cash App. This is where the story gets really interesting. And it's also where a lot of people get tripped up, all because of Bitcoin. So let's pull back the curtain and see what's really driving the performance here. Check this out. Cash App's gross profit up a massive 24% year over year. I mean, wow, that's blowing past the company average. It's basically screaming that this is the main growth engine for Block right now. But you might be thinking, wait a minute, didn't I hear that Bitcoin revenue was down? How does that work? Exactly. And this chart right here just perfectly explains why you have to learn to ignore Bitcoin revenue. It looks huge, right? It's more than half of Cash App's total revenue. But then, look at the gross profit. Bitcoin is responsible for a tiny, tiny 4% of it. It's all sizzle, no stake. A huge, low-margin distraction. The real money, the real story, is in that other 96%. So what happens when we just take the Bitcoin noise out of the equation? Look at this. The core Cash App business, the stuff that actually makes money, the financial services, is growing at a blistering 22% clip. This is the number that matters, folks. This is the real engine we've been talking about. And hey, you don't have to take my word for it. Management spells it out for you, plain as day, right in their 10Q filing, page 42. They say that the margin growth is coming from the favorable economics in Cash App's financial services-related products. They are literally pointing a giant neon sign at where the real value is. Okay, so that's Cash App, the speedboat. Now let's talk about the other side of the business, Square. If Cash App is the high-growth engine, think of Square as the super steady, reliable aircraft carrier that the whole company is built on. So with Square, you've got a really healthy mix of profit coming from two places, the usual transaction fees and then the really juicy, higher margin subscription services. Now, it's not putting up the crazy numbers that Cash App is, but a solid 9% year-over-year gross profit growth, that's nothing to sneeze at. It's consistent, it's profitable, and it's the rock that anchors this whole business. So to recap, we've got fantastic gross profit growth. That's one side of the coin. But the other half of the story, the part that really makes a profit machine work, is cost control. And you can finally see that management's focus on discipline is really, truly starting to pay off on the bottom line. And here's the proof, pulled straight from page 40 of their filing. Management said they were going to cap headcount at 12,000 people. And what happened? They did it. And they're planning to stay under that number. Now, this isn't just some vague promise. This is a hard structural change to their costs. It means as gross profits keep climbing, more and more of that money is going to drop straight to the bottom line. That's what we call operating leverage. Okay, so the profit story, it's looking pretty good, right? It's compelling. But any good analysis has to look at the other side. What could go wrong? And there are two pretty big headwinds kind of tucked away in this report that every single investor needs to have on their radar. I mean, you've got to watch these closely. First up, the regulators are knocking. And it's not just one. The company's talking about inquiries from a bunch of state attorneys general. The SEC is following up on an old short seller report. And the Department of Justice. Yeah, they have an ongoing inquiry too. Look, these are not small things. This is a big, unpredictable risk. We're talking potential fines, penalties, maybe even changes to how they have to operate. And the second risk, this one might be even more worrying. It's credit risk. Take a look at their loan book. Yeah, most of it, the pass loans. That's all healthy. But look over at the classified loans. That's the stuff regulators flag as having a higher risk of going bad. That pile has swollen to almost $250 million. And here's the real kicker. The company says in the filing that this amount was immaterial at the start of the year. That's a very fast decline in credit quality. So this is where it all comes together. This is the big question. There's really no doubt about it. Management has pulled off a pretty impressive turn towards real sustainable profitability. The core businesses are humming along. But you've got these regulatory storm clouds gathering, and you have this credit risk that's getting worse. So the critical question you have to ask yourself as an investor is this. Is this growing loan problem the Achilles heel? Is it the one thing that could completely torpedo the entire bull case? That's the tension. That's the story you need to be watching.